Swing trading options. Getting the best risk to reward. Swing trading options focuses on using one of the oldest and most popular trading methods for trading the markets. It was popularized by the legendary W.D. Gann in the early 20th century, who made millions on the stock market after defining his own unique set of rules and applying them to futures contracts. Many books have since been written about this technique, each containing variations of the one overriding theme. Identify a trend, wait for the pullback, and hop on for the ride when the trend resumes. To do this, you need to understand price charts and technical analysis. Swing trading options takes advantage of short-term moves in share prices and uses the leverage available in options to create an income stream with much less capital than would be needed if you were just buying and selling the shares. Options also give you the ability to make money, whether the move is upwards or downwards. You simply use call options for an upward swing, and put options for a downward swing. If you were trading stocks, you would have to short sell the stock for a downswing, and take on margin risk. Swing trading options can be applied in either of two ways. 1. Using chart patterns. 2. Trend trading. Identify trends and enter on the pullbacks. Using stock chart patterns for swing trading options. Let's take a look at identifying chart patterns. There are a number of well-known price chart patterns, which help traders to anticipate potential entry and exit targets. These include the channel, rising and falling wedges, triangle patterns, head and shoulder patterns, double tops and bottoms, flags, and pennants. These are best recognized by drawing lines over the price action. The trader then waits for a confirmation signal, and preferably one that includes a confluence of more than one signal. For example, it might be a candlestick reversal pattern at the top or bottom of a channel pattern, or it might be after the price consolidates a little and then breaks up or down. Price action reversal signals and their confluence with the channel or other price pattern serves to strengthen the trader's conviction about upcoming price action. Once you enter the trade, the next challenge is to exit before the reversal blows itself out. In our example, it might be close to the other extremity of the channel. You can often clean up with a tidy profit on your risk capital. If you understand the advantages that can be obtained from using vertical debit spreads or straddle options over single options positions in combination with swing trading price action, you can make excellent consistent profits with minimal risk. Option swing trading. The trend is your friend. The second way to swing trade options is to identify trending price action using higher highs and higher lows in a bullish trend, or the opposite if the trend is bearish. The trader waits patiently for a pullback against the trend, at which point an entry level is planned. Drawing trend lines under the lows, if the trend is bullish, or over the highs, if the trend is bearish, can help identify potential entry points. Trend lines also help you decide whether the trend is weakening or not. Some prefer to make the peaks and troughs in a trend clearer by using a zigzag indicator that draws lines drawn through closing prices. If the trend is upward, and you have drawn your trend line under the troughs, you should also take note of the peaks. If the angle of the peaks is turning toward the angle of the troughs, the trend may be weakening, so you need to be more careful. The same goes for a downward trend, only in reverse. In short, you need to have some knowledge of stock chart patterns and technical analysis, so that you can recognize opportunities and time your entry. Good trading psychology and self-discipline are also essential. It is far better to patiently wait for just the right entry signal, rather than jumping in, because you feel you have to be in a trade. The same goes for your exit. Accept a target profit, and don't be greedy. Greedy pigs end up in the bacon factory. Broadly speaking, it's helpful to have a signal that indicates whether the stock is in an uptrend, or downtrend, or just moving sideways. A favorite tool for identifying this is moving averages. Typically, the 10 and 20 period moving averages for the shorter time frames, and the 50 and 200 period simple moving averages, are used to mark out the longer term trends. In stock option swing trading, new opportunities are usually identified, either during the last half hour of trading, or after the market closes, so that you are prepared for entry within the first half hour of trading, after the market opens the next morning. When looking for a reversal signal from a pullback, candlestick charting patterns often provide good signals. Risk to reward, and profit targets. Two important aspects of option swing trading are managing risk and setting profit targets. You can also use trailing stops for profitable trades. Once the first profit target is reached, some futures and forex traders may choose to sell half their position, leaving the remaining half with a stop loss at break even. Perpetual futures and forex contracts do not expire, as options do. Option swing trading presents a number of advantages for the novice trader. It is simple to learn and can be undertaken without giving up your day job. You can make a significant income without the need for a lot of trading capital, as you would with share trading. Using Fibonacci retracements and swing trading. Here's an example of an option swing trading strategy that has an excellent risk to reward ratio. This works just as well for futures or forex trading as it does for option swing trading. You observe that the trend has recently reversed from bearish to bullish. You've noted that it has broken up through the downtrending line and formed its first higher high. At this point, you draw a little box from the previous high across to the right where the current price action is. You then note that this previous high sits at a 50% or 61.8% retracement level to the latest high that is forming. This confluence of retracement level together with the previous high indicates a high probability that price action should bounce off this area and continue upwards in its bullish direction. So you decide to enter a long position in this retracement area and will set your stop loss at the 78.6% Fibonacci retracement level. But your profit target will be at the previous high. An entry at this retracement level, with profit target at the previous high, and stop loss at 78.6% retracement, will provide the trader with a 1 to 2.61 risk to reward ratio, that is, risking one amount to make 2.6 times as much. If the previous high had been at the 61.8% retracement mark, then for the same trade, you would achieve a 1 to 3 risk to reward ratio. This happens more often than you think. But remember, your original entry was based on a confluence of two signals. The 61.8% retracement, coinciding with the previous high. Traders can play around with these entry, stop loss, and profit target levels, depending on what they see the price action telling them. If you can see the 61.8% retracement, coinciding with the previous high, and then observe it meeting a trend line, as a third area of confluence, then you can be even more confident in this trade. In our example here, once the price bounces back to close at, or above, the 38.2% retracement level, then futures and forex traders should move their stops to break even. Stack the odds in your favor, both with confluence entry levels and risk to reward ratios. Have patience. Wait for only the best signals, compound your profits, so that you can increase your position entry size. Do this consistently, and one day, you will be wealthy.